In the next couple of videos, we're going to look at what they refer to as capital budgeting refinements. But essentially what we're going to do is we're going to take the first look at how do we deal with risk when we're talking about capital budgeting. And in the end, that's where we'll talk a little bit more about the refinements, just taking the analysis one step further for some peculiarities that might be in our decision-making process. So we have assumed that all investment projects, to date at least, have the same level of risk. But of course we know that that is not true. We need to make sure that the risk-return relationship is carried forward in every decision we make. So we need to understand that risk and return have to be applied individually to all projects and all assets. So here we have two projects that we've been talking about before. And here's our net present value analysis of the two. Now what we would like to do again is ultimately talk about the riskiness of these projects. How are we going to address the differences between these two projects, if you will? So there are some behavioral aspects, right? Managers can have a feel for the level of project risk, right? So they understand maybe what one project is riskier than the other, but the challenge is they're not able to quantify that. So we want to be able to incorporate the returns that investors will want for this particular project if the company does it. And when we talk about what return investors want, we're essentially talking about the cost of financing for this particular project. So again, we want to address the uncertainty of the cash flows. For a lot of projects, this is entirely where the risk comes from. So in others, in particular maybe international projects, there could be other risk factors incorporated. But in general, the risk we're talking about here is the chance that the cash flows that we predicted in the future are going to be different than what we thought. So again, the uncertainty of the cash flows, that's the degree of variability, that's what we want to measure. So we need to have some methodology of looking at this to assess that risk, right? So we have to look at the probabilities that cash flows will be big enough to produce a positive net present value. Again, this is really just saying over and over again the same thing. However, it's in a slightly different context. One of the techniques we can use is something called scenario analysis. And what scenario analysis requires is for us to actually predict several different outcomes, if you will. And these outcomes can be generally labeled as being the worst case, the most likely case, and maybe the best case scenario. So we want to measure, well, what if we think sales will go up by 5% and we incorporate that into our analysis, that's our most likely scenario. But what if sales actually weren't 5% but were 7%? How would that affect the cash flows? What if instead of 5% it was 2%? How would that affect the cash flows? So again, we want to ultimately measure the riskiness of these net present values in a very similar methodology that we did when we talked about risk and return with individual assets in previous videos. So here we have two projects. Excuse me. Both projects cost $10,000, and here are their cash flows as analyzed by pessimistic, most likely, and optimistic categories. And of course, from that, we calculated their net present values. Again, we assumed a 10% cost of capital, and again, that the cash flows would end for 15 years. So this is, again, the net present value under each one of these situations. So now we understand, right? We're going to predict these different cash flows for different outcomes, and in the end, you just calculate net present value. So the table that we can use is referred to as project risk, but the project risk worksheet should look very similar to the standalone risk worksheet. The difference is we have probabilities, that's no difference, but the difference is instead of entering returns here, we're actually entering the net present values given that particular condition or scenario that's being projected. So in this case, we end up with the expected net present value of A is almost 5,600, and the net present value for B is around 6,700. Standard deviation 2,300 for A, almost 9,500 for B. So we know that B is much riskier, right? If you actually look at the coefficient of variation, you see it's really almost 3 times bigger. And the standard deviation obviously is much larger. So again, we can calculate the risk of these projects. It's a very simple process, right? Once you've gone through the busy work of doing all the different scenarios and the forecasting in there. Another technique that we can use is something called a simulation. And what a simulation will do is it will look at all the variables in the project, and what we will do will be assess some statistics to each one of those scenarios. So if we assume they're all normally distributed, which they're usually not, we could say, well, you know, this asset has it's a mean of 17,000 and the standard deviation is 29,000. And we put those statistics to a particular variable. What the software for these programs does is it randomly chooses assets or chooses a variable value using those statistics, plugs it into the problem, and then it calculates net present value. And it will do this for maybe thousands of times. So in the end, we will be able to get some statistics of the mean and the standard deviation of the frequency distributions that come about from this simulation, which it frequently is actually referred to as Monte Carlo simulation. Unfortunately, Excel does not do Monte Carlo simulation very well. So we do have some issues with needing special software to do this. So if we assume now we know that the riskiness of projects is going to be different, we need to have a way to apply the risk factor. And there's 2 ways we can do this. We can adjust the cash inflows, or we can adjust the discount rate. Adjusting the cash flows themselves is fairly subjective, right? So that's going to require a little bit more judgment on the basis of managers. So it's going to be a little bit tougher to incorporate that into our analysis, right? So what we're going to look at is how can we adjust the discount rate to account for differences in risk. So our formula for net present value is the same. The thing that's different is right here. The thing that's different is instead of using the weighted average cost of capital of the company, we're going to adjust that number to reflect changes in costs due to increased risk or decreased risk of the particular project. So once we have incorporated or looked at net present value, we have to decide how are you going to determine the required return. One of the ways we can do that is by using beta and the capital asset pricing model. In this case, the beta is a project. So it's the beta of the project with which you're going to you're doing the analysis on. And through this process, we can calculate the required return, that is that risk-adjusted discount rate that we could use in the net present value calculation. And as we've discussed before, the security market line creates this blue line, and if projects will have internal rate of returns higher than the blue line, then they ultimately would be accepted, and projects down below would ultimately be rejected. So these projects up here are undervalued, and these projects down here are essentially overvalued. So that's the basis of risk-adjusted discounts. In the next video, we'll take it a little bit of a step further and then talk about some refinements, if you will, to the capital budgeting process.